Tinker with TradeGATEHub, and we are powered by TradeView Markets. You know, there's a lot of confusion out there about where's the economy headed. Did the Fed really talk about a pivot? Yet employment is so strong. There are so many conflicting signals out there that we have the perfect guest to explain where we're at in the business cycle. We're joined by Lakshman, and Lakshman, great to have you here. I see all these different conflicting signals. Here's your kind of a bio of what you've been doing for. We're talking about decades of work, right?
Well, yeah, I when we were doing a little retrospective, like of our current generation's work, and there's that statement people make. Somebody smarter than me said it. You're standing on the shoulders of giants, and so I do have to pay respect to my mentor Jeffrey Moore, who was the father of leading indicators, and his mentor Wesley Mitchell, who defined what a business cycle is. So we're sitting here saying, what's going on, right? We're trying to make a decision.
Yeah.
What's going on, and it's really important to have some bearing as to where the environment you're operating in, right? We talk about trying to understand the economy, demand growth, inflation growth, how all of these things interact with one another. And then we've got fear and greed in there, emotion, because we're all people moving things around. And it gets pretty darn messy. So it's about a little less, about a century ago, Wesley Mitchell was bringing order to the debate that we're having even today, right? Of what is a cycle. And so they came up with the idea of why do free market economies swing up and down? And back then, they were really in your face swings I'm talking activity, not the market, right? So economic activity. And then his protege, Jeffrey Moore, worked on leading indicators of the cycle peaks and troughs.
Well, that's what sets you apart from a lot of other guys that talk about the business cycle and talk about the economy. And you know what? Even the Fed. The Fed is looking at things that are not leading, but looking at the data that they're getting is old data, at least a month old. And they're not going to where the puck is, like Gretzky.
No. So there was this big, I wrote about this, I think I don't even remember, I'm getting old. But I think it was like 14, 15 years ago, we wrote a book. We were talking about like what happened. You're saying like the Fed's looking at coincident data, and that's true. There's a lot of nowcasting, a lot of model building. And there was this kind of, it used to be, right, if you go back to Mitchell in the century ago, and even more, half a century ago, there was a lot of the whole stuff about cyclical analysis was more mainstream. And in academia, there was a lot of aspiring, we called it physics envy, aspiring to make economics and the understanding of how free market economies work a hard science. And with the advent of databases and computers and the ability to crunch a lot of numbers, there was the hope that you could make a simplified model of the world, the free market, and figure out like, if I push this button, then that happens, and if I push this button, then that happens. And you know how the story, it doesn't work, right? So models can be super useful for scenario planning. What do I do if, like, there's a flood? What do I do if there's a shock? What do I do under certain big circumstances? And I want to get some guesstimate of the long-term impact. But for the near term question of, is there a turn in the road? You know, I don't want to run off the road. Remember the road runner? He's always like chase, you know, the coyote's always chasing the road runner, but he never sees the bend and he flies off the end, and, you know.
I've stood on a ledge a few times.
And so if you want to answer that question, if you don't want to fly off the corner, you know, these models don't really work. They just don't.
Isn't that because the economy is almost like an organism, ever changing? So how can something static work? Just like traders say, it's a different market since algos came in and machines are running the show rather than open outcry. So the same with that, you know, models.
Yeah, my father-in-law was an investor, and I don't know if he was paraphrasing somebody, but he said something along those lines, which was, you know, it's like you're at the casino in the markets, right? And but the house is always changing the rules, and they don't tell you, and they're not telling you that they're changing the rules. And you're right, you know, each time it's like this different thing comes into fad. Everybody's running that way, and you've got to
the new edge.
Yeah, you got to watch that rule change, be sensitive to the rule change, which can ebb and flow. And then, you know, there are some things that seem to be really important for markets: interest rates, cost of money, right? The demand growth, inflation. These seem to be pretty important. And what we're taking on, like the piece of the puzzle that we could add in here, is what's the risk of growth turning and going the other way. So first you want to know kind of where are you in an upswing or a downswing, and then, you know, you say, okay, I'm in an upswing or a downswing. What's the risk that it's going to turn and go the other way? If I would, that's really all I'm trying to do. So if I'll switch to this next chart here.
Before you do that, Lakshman, I wanted to ask you on the prior slide. I've heard tons of consensus forecasts, and you say that you point out to your readers the blind spot of consensus forecasts. So as today in real time, what is the blind spot or blind spots that we're hearing on mainstream media that you're seeing? Is it peak inflation a blind spot?
Okay, so I'm just going to assert some things. I'm happy to come back and talk about them. But let's say that there's a cycle in growth and there's a separate cycle in inflation. Those are related, but the timing of the peaks and troughs can be different, and they can lag a bit. Okay.
Right.
So with that, stipulating that, the cyclical peak in inflation is probably in. It's in. We've seen the high in this current inflation cycle. That's a directional observation. That does not say, underscore, I'm not saying a sharp drop in the pace of inflation. Okay, so I'm making a distinction between the timing of a peak in the cycle and the magnitude of the decline following that peak. And I'm saying, yeah, there probably is, the peak is there, but that's very different from saying it's going to drop like a stone.
It could plateau out. Is that the point that you're getting to?
It's more here than dropping. Okay. So the implication there, of course, is that the Fed can't go on hold that easily or pivot that easily.
Well, Volcker thought he had a peak in the 70s, and he was a pretty smart guy, right?
I mean, he was pretty, well, he got, so the hand that he held, he was holding this hand of inflation when he came in. He took over, I think, from Burns, and he didn't have a lot of options, right? So he had to really create or help create a recession. I don't think he intended, he wasn't like, I want a recession. It's the same as Powell, right? He's like, he didn't come out saying, I want a recession, but he was like, I need to do this to destroy demand. So
He had
that
to do it
prices,
twice, so was my point, Lakshman. He
well,
came
yeah,
in,
he thought he got it. He thought he
right,
got it. He
like,
thought he got it,
okay,
and because he took his foot off the brake for a quarter or more,
yeah,
inflation, underlying drivers of inflation, which are forward indicators on inflation, pick up, shot right back up. You could see it on the chart in the 80s. I'll pull up a chart in a minute and
okay,
show it to you.
okay,
And then he had to just stomp on it again and get a really
yeah,
bad recession. 81, 82 was a pretty bad one. So, but on the blind side, the consensus, right? I think the obvious one is soft landing or not.
okay,
Okay. So the one if I want to put in here, and you always have to, whenever you hear the word if, you got to be like, wait a minute, that's a
yeah,
speculation.
hedge.
So the one if here, it's hard to know what the hell the market is thinking, but if the market is thinking that there's a soft landing, okay, now they're very much in our world, the Economic Cycle Research Institute's world, equities world. Is there a cyclical turn? And so I can do all the we have a lot of real-time examples of looking at cycles. I know the historical relationships between markets and cycles. There is a good relationship between equities bottoming and business cycle troughs, or even growth rate cycle troughs. And there's plenty of times that there's been misreads by the markets, right? A lot of false signals. So what becomes important is what are the non-market related forward-looking indicators saying? And I can tell you that they disagree with the soft landing scenario. They don't point to a soft landing. So there's no reacceleration in sight for economic activity based on these indicators away from the markets, and even many market indicators, to tell you the truth. Separately, you could ask the question a different way. I'm only thinking in directional cycles, right? So I'm like, did the market is saying up, and is the economy going to go up? Okay. The other way that to reconcile us not seeing a soft landing and the market going up would be to take a look at, does the market care if there's a recession? I guess it seems like they should care, given demand and the relationship with earnings growth and all the other things, but maybe not. Who
They
am I to
cannot
judge?
care for a long time. They
Who am
cannot
I to
care,
judge? Yeah, who am
right?
I to judge? So, but I look back, there's two times. I mean, you can think about them. One is in 45, when the war ends, World War II, and you have basically a lot of people came home from the war, and they weren't employed, and it was recessionary, and you were switching from a war footing, all that demand, to a domestic demand consumption thing, and there was a recession there, and the market didn't care at all because it could see right through that to the peacetime growth. So there is a recession, and there is no market decline. So it's possible, right?
Okay.
I don't see that environment today. The other example we have would be the Roaring 20s. Okay,
Yeah.
maybe that's a little closer. And in 26, 27, there was a recession, and the market didn't go down.
Stop.
It didn't go down. It kept going. Of course, it all ended in tears, right, with the 29 crash, but it did go through, and an eventual depression, but it did go through the 26, 27 recession, and didn't really care about it. It wasn't a bear market there.
That's very interesting, because I know, you and I come from different disciplines. I'm more of a technical guy, a correlation guy. And there is actually a case, a technical case, using Elliott wave, that said this whole correction that we had to 3,600 was a wave 4, which implies one more wave to the upside and new all-time highs. And maybe it is that parallel that you just brought up, that the market sees through it, and then sometime next year, instead of now, when all the Fed possibly continuing to make a policy error by continuing to tighten, is sowing the seeds for what happened in 29 next year.
But totally possible. But the problem with that is that there's just the coincident data of economic growth. So we look at, there's leading data and there's coincident data. And, we keep, I watch the basic dialogue around the soft landing scenarios. And, I commented on something that someone wrote yesterday on Twitter. I think there was housing is weak. Okay, that's recessionary, but industrial production is strong. So, there's no recession. So,
yeah.
And on the surface, sure, it seems like that if you just read the headline. But in our view, that's like, it makes total sense. It totally fits, because industrial production is a coincident indicator, and the housing stuff, without getting into the particular indicators, conceptually, it's a driver of the economic cycle. It's not the only one, but it's an important one. It's a big one.
Yeah.
And so when we look at the different sectors of the economy and what direction they're going, of course, housing's cycling down and is weighing on growth. And it's part of the reason why there's no soft landing yet, or hard landing for that matter. It's not over. The cycle downturn is not over. But it's completely, I could see how it's confusing to quote unquote the market, because if you equate, this housing report came out and it was weak, and this IP report came out, industrial production, and it was stronger than expected. Also, there's all the unexpected game. But, those are two different things. You're comparing apples and oranges. IP is coincident. Yeah, maybe it hasn't just quite clearly peaked and turned down yet. Perfectly fine. Forward data is the important one. You want to go where the puck is going. Right. You want to be where the puck's going, not where it is. IP is the puck. You got to anticipate that. So anyway,
where are we going?
Where are we going? We're still cycling down. I mean, this is a little bit of an older chart, but I want to show it to you guys, just to relate the market with. This is from a week or two ago. I was giving a presentation just to relate the market to the cycle. So the shaded areas.
The S&P tacked on 300 handles in 2 weeks.
It's up here.
It's
right up here.
That's pretty quick, right?
Yeah. No. It
squeezed a lot of shorts.
It squeezes a lot of shorts. You have, I don't have it on this chart, but in the, coming out of 01, going into 01, it rallied 19% in 2 months.
Yeah,
going into a recession. I mean, you could do. We can play the game.
Lots of examples of bear market rallies.
I don't want to so much focus on this. I know the market's up. It's hoping for a soft landing. What I wanted to just show your viewers for a second is shaded areas. Yeah. Those are decelerations in growth. Those periods. The white areas are accelerations in the business cycle, the coincident data. My only point here is that in the post GFC world, you get your big drawdowns where these arrows are.
Yeah.
You get those inside shaded areas. Okay. And so the basic kind of where are we? We're in a shaded area. We're not in the white area.
Are we almost in the white? Can that band can that band expand and
this is going
horizontally?
So what I'm telling you now, the only reason this is white is because I don't know what's happening in the second half. I want to wait till the coincident data all comes in. Okay. But I can tell you our prediction is that we don't see the end of this shaded area yet. This shaded area is extending in front of us.
Okay.
So that bend in the road toward a recovery is
Way off.
it's not in sight yet. And so that is a problem. Here's some leading indexes, same shaded areas.
Yeah.
Here's the coincident index. There's the COVID recession. There's the recovery. Oh, sorry.
It's okay.
There's the recovery right here, running way up. And here's the slowdown. We've been in this slowdown and we're not in a recession yet. This hasn't gone negative yet, the coincident index.
We're back to where we were before COVID. Yeah,
you're right there. Yeah, it's not that far off. And the only reason this is holding up really is because of jobs. But what more importantly, where's the puck going? There's the long leading index. It does not include stock prices. Here's the weekly leading index. It has a shorter lead, this one.
Yeah.
Here's the short leading index. Stock prices are more inside short leading indicators. They're going down. So sequentially, these are moving down. So the expectation is very much that the coincident index is going to keep going down. It's certainly not turning up. You need upturns in the indicators,
right,
before you see an upturn in the coincidence. So peak, 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 peak. I need a trough. I don't have a trough. So when the market says, oh, you know, we're off to the races, it's all good, I question it. I don't particularly look at, you know, individual company stuff, but I've you know, you have a couple of friends who do, and I'm kind of letting them just give me summaries, and it's interesting, you know, the managers, the company managers, basically are saying, hey, things were pretty good earlier, and then you're seeing things start to fray, and
well, could that be because we're all in prison for 2 years?
Yeah. Oh, all of
and
those things.
I'm gonna live, man. I'm free again. And
Damn,
then you go out and you get COVID, right?
Damn,
you're
the
free
torpedoes.
again to get COVID.
So many people are, you know, they got to get out of the house. They got to take the family out. They got to do a lot of stuff. I get it, 100%. And these kind of relationships keep holding. That's the short leading index against the quality spread, which has started to recover a little bit, but it's just premature.
Is that junk against treasuries?
Yeah, it's like, you know, investment against junk, I think, is this particular quality spread. But, you know, you get the idea. It's a kind of, it's another risk metric.
Right.
This is I was doing something particular for, this is iPhone sales, and you see basically around 12, they start to get cyclical after you get penetration. And it's really amazing how iPhone sales revenue growth really pretty much conforms to growth rate cycle slowdowns, even though this thing is all, you know, this iPhone stuff, you know, it's like, oh my gosh, the iPhone, whatever, 10, 11, 12, 13 is always pushing this stuff. But hey, it's a discretionary spend, and discretionary spending is cyclical.
You know, all the companies just raise their rates.
Yeah.
By like $5-6 last month. Yeah. They'll
try. I mean, this is a proxy for, you know, just you know, for if you're a business, if you're not an individual, right? So you switch to businesses. If it starts to squeeze a little, you probably tweak your advertising spend.
Yeah.
And so there's advertising growth against the cycle. You know, crypto against the cycle. Crypto is kind of risk on, risk off.
Yeah.
So you know, those kind of general things. I mean, all of these are trying to go up now. They're hoping for the soft landing. But if you, I'm just layering market things against cycles. What we do is talk about, is the shaded area going to flip and go to white? Or is it going to flip and go back? And the contrast, the divergence between what we're seeing and what you might be hearing, or the technicals might be saying, or whatever, right, is that the shaded area that's downturn is not over, and the end of that has yet to present itself in the forward-looking data. Okay. So, these are different measures. Here's a picture of the future inflation gauge. And you would ask me, is the peak in? And yeah, the peak's in. It peaked back here. So It's coming down, but it's not plunging.
Right.
And so, here it is against yields. What's interesting here, see these yields run up here?
Yeah.
This is 18. This is basically the screw up that we're living with today. So here in 18, he
was tightening.
He was tightening, and he's like, oh, all these bond gurus and everybody was like, oh my God, it's gonna, the rates are gonna run off to 4, 5, 6%. And the future inflation gauge turned down.
Yeah.
And so then you had the Powell pivot comes in here in 19. Here's January 19. There's the pivot right there.
Yeah. Yeah.
Well, market crashed and pivot.
Well, it wasn't just a pivot. He sang Kumbaya with Yellen and Bernanke.
He did the whole, this was crazy. And then so over here, look at this future inflation gauge, man. It takes off in 20. So I'm not doing anything radical here, but by the fall of 20, we're in here.
Yeah.
And we're saying, hey, there's this inflation cycle upturn, which means persistent. It's not transitory, it's persistent. That's knowable back there, and these guys screwed it up. This is super complicated. I'm not going to get into it.
So if they're consistent, they're going to be tight too long, aren't they?
They're going to be tight. They're going to be tight too long. Here's one. I want to give you a quick global backdrop right here. So I talked about the long leading index for the U.S. This is for 21 countries. We do it for all the rich countries, all the big emerging markets, including China and India. They're all in here. So the 21 country forward-looking data. Forget about IP. Forget about GDP. I'm talking forward-looking data. Forward-looking data is down. This is a kind of a global recessionary reading.
It's almost as down as much as it was in the middle of COVID.
I know.
The world's in worse shape.
This is why. So for me, I'm following. Remember, I'm standing on the shoulders of giants. These guys, what is this thing we're in? We're in cycles. Okay. How do you predict them? Well, you got to use these leading indicators. They're pretty complicated. We've done, my whole career is on how to forecast the turns. This is the 21 country long leading index. It's very clearly down. Now, what are the banks doing? The central banks. This is the highest reading in history of the proportion of central banks around the world raising rates in tightening mode.
Wow.
And you don't have to be an analyst to kind of figure out that if the drivers of the growth are pointing down and everybody's stomping on the brakes, be careful what you wish for.
What kind of a cocktail is that?
This is a Volcker cocktail. I mean, I don't know what Volcker drank.
What a hangover.
This is a Volcker cocktail.
It's at least a triple shot in there. Yeah, I'm not going to feel too good.
No,
with this combination.
We will survive. We will totally survive all this stuff. But it is what it is, man. That there is so there's a moment here, and I don't pretend to know the psychology of Powell, if he is going to be a Volcker, if he has his intestinal fortitude. I don't know if he does. He says he does. He wants to. You could make the argument either way. But
the yield curve inversion, you think that'll matter to him?
Yeah, I mean, look, we actually ended up, it's not that we haven't looked at yield curve. It just doesn't work as a decision-making input. It certainly is consistent with recession. But the signals you can get out of it, first you can torture the data and say, I don't like this one, I like that one, I don't like this one, I like that one, all that.
Yeah.
And then and you can make it say whatever you want. But but the basic issue is that the lead is too long and too variable to make a decision.
Well,
So
I'll tell you what, you were definitely an antidote for the hopium that is
yeah,
out
hey,
there,
look, I'm
Lakshman.
as hopeful. We're gonna make it through this. But it's gonna get a little messy. And what you're dealing with is that the inflation cycle has slammed some guardrails on what these guys are doing, and ladies,
Yeah.
in terms of the policy stuff. And so one of the critical things, obviously the growth outlook is a critical, but what's really, I think what's particular, a lot of stuff is important, but one thing I'm looking at closely is the future inflation gauge. Does it start to move down more sharply? Because if it does, it starts to ease the guardrail that's been slapped on them off. And it's not yet.
Okay. Well, I'd summarize that you have talked about, especially, this chart with the World Central Bank Diffusion Index.
Yeah.
And, what most of us only think locally and figure, 2.5% rates are nothing. But with what's happening globally, synchronistically, every central bank is tightening except China.
And Japan's taking it
me.
slow. And I think Turkey, in their wisdom, did something last night, but I don't think it matters.
Anyway, in the middle of the summer, I welcome shade in the high desert, Lakshman, but I'm not looking to be aggressively bullish in a shaded area by at business cycles.
Yeah, look, at business cycles at Twitter, you can see what we're saying publicly. This is a weird cycle, but if some of your viewers are in commodities, the bottom line is industrial commodity inflation. And you can see it's volatile, right? So it's exciting to trade. The middle line is a short leading indicator of the global industrial cycle. And that's a long leading indicator of the global industrial cycle. And being down this low, it's hard to see a trough in global industrial growth. That's not country specific. That's global factory activity. It's hard to see a trough until, in the more optimistic outlook, you'd say, in the first half of next year, but it's not there yet. We don't have an upturn yet. We don't have an upturn.
Okay.
You need to, we don't have that. So, hey, if the market gives you a gift, take it and save a little for a rainy day, so that when things really do trough, you can go in and take on risk.
You have your fight.
Yeah, I mean, I'm all for taking on risk. Look, we love calling the upturns too. Those are moments when everybody's scared and you can embrace the risk.
Right.
I wouldn't do that today.
Okay. Well, I know you say you're standing on the shoulders of giants. Whoever succeeds you will be doing the same, Lakshman.
Oh, I got a great team we're working with, and they're very, very hardworking and are soaking up all this cycle stuff. So
you got to follow Lakshman's research, everyone, to have clarity in what really is a kind of a muddled, and you listen to everything that people are saying. Thank you for giving our community and everyone who watches this later clarity, Lakshman.
Thank you. It's my pleasure.
You're a great watchman. You're a great watchman for people that are involved in this.
So one of Dr. Moore's colleagues, he used to call us monitorists with an I.
Okay.
Right. And so instead of being monetary people, we're monitoring, we're watching.
Right.
That's a really good way of putting it. We're monitoring. All right.
Thank you so much, Lakshman.
Thank you.
I've enjoyed it. I hope everyone else has. It's going to be worth listening to again. But anyway, we're still in shaded areas. That's a wrap, everybody. Thank you, Lakshman. And
thank you.
Have a great weekend, everyone. I'll see you next week. And don't just count your economic indicators, count your blessings.